Welcome to Reverse Mortgage and Beyond, the podcast where we take you inside the world of reverse mortgages. I'm Cheryl Scheidell, and I have been in the mortgage industry since 2002 and have specialized in reverse mortgages for the past 10 years. We'll cover topics like reverse mortgage basics, purchasing a home, and the myths about reverse. You'll also hear from some trusted referral partners. Let's get started. Hi, everyone. Welcome to Reverse Mortgage and Beyond. I'm your host, Cheryl Scheidell. I'm with Barrett Financial, and today I'm here solo, and I just want to educate you about reverse mortgages, the basics, and then we're going to do a second part, and we're going to talk about how to purchase a home with a reverse mortgage, as well as the myths about reverse mortgages. But what I'm going to do first is I'm going to tell you a little bit about myself, because I haven't had an opportunity to do that yet. I actually am from Arizona, born and raised. Went to Moon Valley High School, went to NAU. I actually have a degree in hotel and restaurant management, but I found my way into the mortgage industry in 2002. So I've been through all the ups and downs with the market, and about 10 years ago, I finally found my niche. My niche is reverse mortgages, and I had 3 of them fall into my lap. What happened was I had a referral source of mine came up to me, and she's like, "Hey, do you do reverse mortgages?" And I'm like, "Absolutely." And then I walked into my manager's office. I'm like, "Hey, do we do reverse mortgages?" And he's like, "Yes, go talk to the director of reverse mortgages." I'm like, "Okay." So I went in and talked to the director of reverse mortgages, learned how to do my first proposal to go off the scenario of the people that I was talking to. And which I'll just tell that story right now. What happened was I went to a home. There was an 80-year-old mom at the kitchen table, the son, the daughter-in-law, and the daughter, myself. And then I had my manager on a speakerphone in the middle of the table. And so we went over their numbers, their proposals. And then the next day, the son called me and he's like, "We just have a couple of questions for mom." And I'm like, "Okay." I answered those questions, and then the next thing he said to me, he's like, "My wife and I want to do this too." So that's how I fell into reverse mortgages. And I have to say, about 5 years ago, my mom, I would be visiting her, and she overheard me on the phone talking to somebody, educating them about reverse mortgages. And she's like, "I think I need to do this too." And so my mom actually has a reverse mortgage, and I believe in them so much that my mom has one. So just a little bit about myself. I also volunteer with Valley Life. I work with their gala charity. I help co-found a women's organization, Arizona Women of Impact. Then I also have a radio show on AM 960, The Patriot, called Is a Reverse Mortgage Right for You? So if you like what you hear today and you want me to go over some numbers with you, I would love to, just see how I could educate you and help you out in your situation. My number you can reach me at is 480-817-4324. And then I also have a website, reversemortgageandbeyond.com. So you can go there, and there's clips, there's information, there are calculators that you can go in and see how all this works. But what I'm going to do, and maybe you can see it, maybe you won't be able to, but I'm going to go over the basics about reverse. And I got a PowerPoint here, so I'm just going to, hopefully you can see some things up on the screen. How this works is, what is a reverse mortgage? So a reverse mortgage is also known as a HECM. A HECM is a home equity conversion mortgage. So it's converting. So think about your 30-year fixed. Every time you make a mortgage payment, your balance is coming down ever so slightly, but it's coming down. With a reverse mortgage, what happens is we pay off your existing loan with the current bank that you have. So that extinguishes that monthly mortgage payment. So now you have a reverse mortgage, whatever that balance was, plus the closing costs, now you have a reverse mortgage. And instead of your balance going down because you're making a payment, you're not required to make a payment with a reverse mortgage, so it's going up in reverse. So no mortgage payment is, you don't have to make a mortgage payment, but what happens is the loan to value is going to be very low. So we're going to be doing, depending on your age, like a 37 to 43% loan to value. So we're not going to be up in the 80s or the 90s. So just to understand that, because we want to leave equity in the home. So what is a reverse mortgage? You don't have to make a mortgage payment. It's to help you access the money in your house. So think about it this way. You are living in your piggy bank. So why don't we crack open that piggy bank and tap into, it's like it's been a savings account for you. So let's tap into that and use that money to assist you. There's 14 plus trillion dollars in home equity out there. Why aren't we using it? Why aren't we using it to get a new roof on our house? Why aren't we using it for in-home health care, to take the grandkids on memorable vacations, to actually, I have a client in California, in Santa Barbara area. Her husband is having some memory issues, and they've already done a reverse mortgage with me. And they're looking at keeping the money under management and using the money from the house, to pay for his memory care when the time comes. So they're going to use money out of the house to keep her, the wife, in the house, and then pay for his memory care, and then keep the money under management, because they don't want to tap into that. So then that way it could be still growing for when she needs it for the healthy spouse. So just some ideas of what you can use a reverse mortgage for. The loan, one person has to be 62 in the household. So that first example I gave you, the wife was 64, so that overcomes the guideline of 62 and older, and the husband was 58. So what we did was we ran the numbers. It's based off of actuary charts. So we ran the numbers off of the 58-year-old's age, the value of the home, the interest rate, and then we come up with what's called a principal limit. The principal limit is basically the loan amount. And then what we do is we have that loan amount, we subtract out the closing costs, we subtract off the loan amount if we're paying that off, and either, it's a wash and then there's nothing left over, or there might still be some money available to you to use, maybe $5,000, $50,000, whatever, but then that'll be a line of credit. So we're paying off a loan, we're getting rid of that monthly mortgage payment, and then you could have a line of credit available to you left over. So that's just how it's structured. So it's based off the lowest of the two spouses, off of their age, the value of the house, and that's how we come up with a number. Now, some negatives that you might have heard in the past is that the person leaves the person is forced out of their home. Well, when in the past, the guidelines, people were getting around using the younger of the two by not putting both people on the loan. So if you're married, you have to both be on the loan, because God forbid one spouse passes away. Now, because you're both on the loan, the second spouse is still safe in their home. So that's how that works. But that was one of the negative connotations about reverse in the past, is that, you might have like I had a client, 94 and 78. He passed away. If she wasn't on the loan, she might not qualify to stay in the home. And so that's why they made it a guideline that if you are married, you both have to be on the loan. Okay, so let's see here. The loan will be repaid once the borrowers no longer live in the home. So it has to be your primary residence. You can't do this on a second home. You can't do this on investment properties. It has to be your primary residence, because we want to keep you safe in the home, right? That's the whole goal, is to keep you safe in the home. In the past, there were people out there getting the reverse mortgage, not having to make a mortgage payment, and then they were renting their house out. You can't do that. So just so you know. And also what you need to know is, and 1 year from the anniversary date of getting the loan, you're going to get a letter in the mail from the lender, and they're going to ask you, is this still your primary residence? So we want to make sure that you are still with us on this earth, and that it's still your primary residence. So these are just some key factors about reverse mortgages. There's different ways to pull the money out. You could have a lump sum distribution, a line of credit, or monthly distributions. So typically, if people have, money left over after we've paid off their loan amount, they could say, okay, we're only going to give them up to 60% of that money at closing, because believe it or not, there are people out there that like to spend money. And so they put a guideline in place that whatever you have left over, you can have up to 60% of that money. So for example, if you had $100,000, we would allow you to take up to 60% or $60,000 out at closing. That's just an example. And then that 40,000 is actually staying in there as your line of credit for a year. And that 40,000 is actually growing for you. So it has a growth rate on it. So these are just things that people don't know. So when I talk to financial advisors, they're like, what? This is amazing. And so sometimes, people use their house as a wealth building tool. So just some ideas there, but you could do a combination of the two. I had a gentleman, when he was closing, he's like, I want to go on a hunting trip. But he wanted $500 a month to be put into his bank account until that money was all gone. So he took $5,000 out at closing so he can go on his hunting trip. And then he had $500 put into his bank account on a monthly basis until his line of credit was gone. So there's just a different combinations of things you can do. Now, we also have proprietary products that go down to 55 years of age and up to $4 million in value. So the home equity conversion mortgage, the HECM, the reverse mortgage, that's an FHA product. You have to be, one person has to be 62 in the household, and it goes up to almost $2 million right now is the home value cap. Proprietary products go down to 55 years of age, and I've had people come and talk to me about this, and we go up to $4 million. And that's how we can do those homes. Like in California, I had somebody $2.3 million for her husband for the memory care. Also had somebody $2.8 million. She's 75 years old and she wants to remodel the front of her house. So I'm just like, whatever you want to do, this money is yours. That's the other thing. Remember back in 2008, the banks were freezing the lines of credit. Bank of America, Wells, Chase, they were freezing those lines of credit. They can't freeze this line of credit. This is your money, and you can use this however you want. You can just take it out and put it in a savings account. I actually, 1 month in Arizona here, I was at a house in July, and the AC had gone out. They had 1 week left over on their home warranty. They were getting the reverse mortgage just to have a savings account. So people use this for whatever they find their needs for. Now, these are just some statistics. I don't know if you can see it or not, but basically the big one here is that 10,000 people per day will turn 62 for the next 20 years. Pretty amazing. And 3,000 of those people are still making a monthly mortgage payment. So just some statistics there. Now, here's some of the benefits of using a reverse mortgage. Tax-free money. So this is considered borrowed money. So you won't be paying income taxes on that. So once people find that out, they're like, bonus, sounds good to me. We do minimal credit requirements and qualifications, but we do a financial assessment. So I've helped people with, I have some people right now, 820 credit score, but then we also have people that are in the 500s. And so we can help all credit scores because we're not going so much off the credit score, because we don't do debt to income ratio for qualifications, like DTI, you hear that number thrown around for your 30-year fix. We do residual income. So we're gonna qualify you hopefully just on your Social Security. And then we take that number and we subtract out certain things. We do a 2-year look back to make sure you paid your property taxes, your homeowner's insurance, and your HOA on time. And that's what helps us get through the qualification process. So we want to make sure they have X number of dollars at the end of the month for residual income. So I qualify people as best as possible just off their Social Security. If they have other income, that's great, but we want to do as minimal paperwork as we can for you. And then we just want to make sure that you have X number of dollars left over at the end of the month. Now, let's say you have someone who's had some challenges and they don't have good credit. Then we have something in place called a LISA, a life expectancy set aside, LESA. So I have some clients that I'm helping. They're here in the Valley. They owe $600,000 on their house. Their house is worth over $3 million, but they had started a bankruptcy because they didn't know about the reverse. But now we're unwinding that bankruptcy because it hadn't gone through all the way. And they're in the process right now, and they're going to get the reverse mortgage, but they're going to have this LISA account. So how this works is we're going to calculate what the property taxes are on a monthly basis and homeowners insurance on a monthly basis. We're going to look at the actuary charts to see how long we anticipate they're going to live to be. And then we're going to multiply that out, and we're going to create an account so they never have to worry about paying their property taxes or their homeowners insurance, because that account will pay for it. Because we want to make sure that property taxes are being paid, because we don't want to go into a tax lien situation. And then we also want to make sure that homeowners insurance is on the property, because God forbid if there's a fire, we want to be able to rebuild the house, because that's, we have a lien on the house, just like you would a 30-year fix, there's a lien on the house. So that's the other thing. You still own your home, or you have it in the name of your trust. The bank does not own your home. That's one of the biggest myths. So I'm starting to talk about the myths, but that's one of the biggest ones. So government loan, so it's low risk. There's no restrictions on how you can use the net proceeds. Repayment of the loan is capped at the home value. So, and then I'm going to come back to that, and typically does not affect Social Security or Medicare, and no monthly mortgage payments. So let's talk about repayment of the loan. So this is what happens when it's no longer your primary residence. What's going to happen is either you move out and you go live with family or assisted living or whatever the case may be, or you pass away. If, for example, you pass away, you've aged in place, you passed away at home, your beneficiaries have two options. They can either refinance the house into their own name, or they have up to 12 months to grieve, to purge, and get the house ready for sale. Now, if we have a market like we have today, and the value of the house is here and the loan is here, they pay back the bank the loan with the accrued interest. They pay the realtor fees and closing costs. Whatever's left over, they get. But God forbid we have another 2008, but we've got guidelines into place, so this doesn't happen. But if we had another 2008 and the loan was up here, so it's upside down, and the value of the house is here, the beneficiaries or you are not responsible for that deficit. So once people hear this and understand that, oh, you can't come after me for all my belongings, then they're like, let's do this. The beneficiaries, the adult kids, I love talking to the adult kids, and they're like, what's the catch? And I'm like, the catch is that maybe your inheritance was up here, and now you're just getting here because mom and dad are going on vacations, they're enjoying life. And typically the adult kids are saying to me, well, that's fine with us because we already have our own retirement. So just something to keep in mind on how all that works. So we've talked about reasons to use a reverse mortgage. Social Security, you could supplement your Social Security and income. Like I said, you could put money into your bank on a monthly basis. You could postpone Social Security. It provides an income the borrower cannot outlive, because this loan is good until you're 150 years old. So I think we're going to be okay there. You can buy a second home with it. You can, I had somebody pay off $100,000 worth of credit card debt. She was paying all that interest, so she got that taken care of. Age in place, all the things that we already talked about. Just really quick, over the next 10 years, aging early boomers will result in 50% rise in the number of people 65 years of age to 74. So just some statistics here. And Americans 62 and older hold 14 trillion plus in home equity, and 72% of boomers are aware of reverse mortgages. So it's just about education, and that's what I want to do. Is I'm just out here educating the community to understand. And I feel like people are starting to come around, because once I talk to them, they start to understand it. Then they're like, how come we don't know about this? I had a realtor come to me. He's like, I don't like reverse mortgages. I'm like, all right, tell me more. He's like, well, my neighbor lost her house,
And I said, all right, what happened? And he said, well, she did like to gamble. And I said, well, maybe she wasn't paying her property taxes and maybe she wasn't paying her homeowner's insurance and she was foreclosed on. So he ended up giving me a referral for his friend to do a reverse mortgage on his house. And then that went all great and good. Then he gave me a referral for a purchase on someone buying a home with a reverse mortgage. And we'll get into that in the next episode on how that works, because you have to think backwards on how that works with the numbers. And then within 9 months, here's a realtor who didn't like reverse mortgages, ended up doing his own house. So once people get educated, they understand how this works. They're like, I want to do this. And then they tell their friends. So I do want to talk about this before we wrap up. Think about your income. You've got 3 different buckets. You've got your Social Security and your pension if you have one. You've got your 401ks and your IRAs if you have one. And then you have your house. Why not tap into the house like we talked about earlier, keep the money under management, your financial advisor loves that, and then use the house to pay for the new tires on the car if you need it, and the air conditioning unit, whatever the case may be. But keep that money under management and let's just utilize this 14 trillion and help ourselves. I had a lady, she was only getting $800 on Social Security, and I was able to qualify her to get a reverse mortgage. I've held people check to check, $30 left over at the end of the month. And then I have people in $1 million homes free and clear that are tapping into that equity and using it for all different types of things. And you can actually refinance a reverse mortgage, believe it or not. I had a pastor come to me and we did his loan. And then this is when the market was going wild. The value of his house kept going up. You had to wait a year in order to refinance a reverse mortgage. There has to be a benefit to the borrower. But he came back to me. He's like, hey, can I refinance my reverse mortgage? I'm like, absolutely. Because he had aged up. Because the older you are, the more access to the money you get in your house. So someone who's 82 is going to get more money out of their house than someone who's 62. So he was aging up. The value of his house was going up. And he was able to refinance his house. We did it 3 times because he was getting ready to retire. And he's like, I want to get this money out of this house. We almost did it 4 times, but the numbers didn't quite work because there's a formula and a calculation that we have to do to make sure there is a benefit to you, the borrower, to get that money out. So let's see here. 10,000 people turn 62 a day. There's fewer pensions out there. Lower returns on investments in the last couple of decades, or on investments for decades. 76% plan to delay retirement. So that's kind of interesting. That's a high number. Greater need for security and certainty than ever before since we live longer. So a lot of people are living longer these days. And so that's why this is good that we can tap into the reverse mortgage with the homes. Now, if all baby boomers retire at 62, 84% would be in jeopardy of running out of money. 84% if they retire at 62. I have people I'm talking to all along, they're in their 70s and they're still working. If all baby boomers retire at 66, 50% would still be likely to run out of money. So how this works is, if you decide that you want me to educate you and learn about this, I'll come and see you. We'll talk on the phone, whatever works best for you. But just how this works is, I educate you, but I do this every day, so I understand this. So we actually there's one extra step you have to do that you wouldn't have to do normally on a 30-year fix. You actually have to do a counseling session. And a counseling session is not talking to an underwriter. It's talking to someone like me on the phone, or you can go in person. Typically people do it on the phone. I've only had one person go in person, but you can go in person. And you just get your questions answered again. So they're going to talk to you about what I talked to you about with your own personal scenario and numbers. You get a code, so that way the counselor can see the paperwork and the numbers that I presented to you. So that way you can ask the same questions, you can hear it again, you can, maybe we didn't touch on something and you thought of a question, and so you can ask the counselor the question. And so you do the education with me, the counseling session. We cannot order title or appraisal until you've done your counseling session, because we don't want to spend any money until we know you're going to move forward and go through with this. After that, we do the application. We get all your supporting documents, just the easy stuff like your Social Security award letter, your IDs, your tax bill, your current mortgage payment or statement if you have one, the insurance. That's like your first set of homework, I like to say. Then we put the file into processing. They give us a second set of homework. Then it goes into underwriting after we get the appraisal back and title back. The underwriter typically gives us the third set of homework. And then we go to close. And so then at that point, your loan would be paid off with your existing bank. And then if you have funds available that you can get out at closing, you can do that. Or you can just keep it in there and then you could take it out whenever you want. So you could call up the bank and then they would deposit it into your account within 3 to 5 days. So it's a little different than it used to be, but it's really good. Fixed products as well as adjustable products. The fixed products, you have to take all the money that's available to you out at closing, and then they're going to be making the interest on that. With the adjustable products, that's a line of credit. So you're only paying money, or interest, I should say, on the money you pull out. So think about it this way. If you have a $100,000 line of credit, but you only pull out $10,000, you're just paying interest on that $10,000. That $90,000 that's sitting in there, it's growing for you with a growth rate, whatever the interest rate is, plus a 0.5 point. And that's how that works right now. So if you had one with Bank of America, you take $10,000 out. Bank of America is using your money, but they're not letting your money grow for you, but your money is growing here for you in your house. We use a 4% appreciation rate when we're doing this. Property eligibility. So it has to be single family homes, 2 or 4 fourplexes, 2 or 4 units. We have to do FHA approved condos, or we have to get a condo approval, but I have gotten condo approvals before. Then we also can do manufactured homes. What we can't do is investment properties, vacation homes, or mixed use like commercial. Like I had a gentleman come to me, he lived in the house, but he also was a group home. So that was more of a business, so we couldn't do the loan on that. The biggest thing why we have such a bad rap is that it's 2% of the value of the house, one-time line item. So if the house is worth $400,000, one-time line item, you're paying $8,000 for your mortgage insurance. And everybody puts into that mortgage insurance bucket, whether your family uses it or not. That way we don't have another 2008 and we go upside down. So I'm going to wrap it up here. This next episode, I'm going to talk about the myths of reverse mortgages. I'm going to talk about how you can purchase a home with a reverse mortgage. And I'm going to talk about a second lien position reverse mortgage on how that product works. So please subscribe so then that way you can get additional episodes. I can be reached at 480-817-4324. This is Cheryl Scheidell with Barrett Financial. Thank you.
Again, this is Cheryl Scheidell, NMLS number 886425 with Barrett Financial, an equal housing lender. Please remember that loan programs, rates, and eligibility guidelines are subject to change and may vary based on individual circumstances. Nothing discussed in this episode constitute a loan offer or credit decision. Any examples or scenarios shared are strictly for illustrative purposes. All loans are subject to credit approval and underwriting conditions.